Let me tell you about the nightmare that woke me up at 3 a.m. last Tuesday. I dreamed I was standing at my retirement party. Everyone was smiling, handing me cards, telling me to enjoy my freedom. But when I looked down at my phone to check my portfolio, the one I'd spent 30 years building, the numbers were red. Bright, bleeding red. The market had crashed, and I had just submitted my resignation that morning. In the dream, I couldn't undo it. I couldn't go back to work. I was 65, holding a cake that said congratulations while watching my life savings evaporate in real time. I woke up in a cold sweat. And here's the thing, I'm not even retired yet. I'm 58. But that fear, that very specific terror of working your entire life, doing everything right, and then having it all unraveled by forces beyond your control right when you need the money most, that's not just my nightmare. If you're over 50 and watching this video, I'd bet my retirement account that you've felt that same anxiety. Maybe you've looked at your 401k and thought, what if 2026 is like 2008? What if the market crashes right when I retire? Maybe you've read the headlines about economic uncertainty, inflation projections, potential recession warnings, and asked yourself, am I really ready for this? Or am I walking into a minefield blindfolded? Here's the truth. The timing of when market crashes happen matters more than you think. And the first 3 years of your retirement, those aren't just important years, they're the danger zone. Get those wrong, and even a $1 million portfolio might not last 20 years. But get them right, you could retire in the middle of a recession and still sleep soundly. Today, I'm going to show you the one strategy that financial advisors charge thousands of dollars to explain, and we're going to break it down so simply that you'll wonder why nobody told you about this 30 years ago. This is about the bucket strategy. And if you're over 50, this might be the most important 15 minutes you spend this year. Let's map out your safe path to retirement.
Imagine you're planning a cross-country road trip. You've got your destination, retirement. You've got your vehicle, your portfolio, and you've got your fuel, your savings. Now, imagine that somewhere along that route, there's a section of highway that's notorious for sinkholes. Sometimes they appear, sometimes they don't. But if you hit one going full speed while carrying a full load, your entire trip could end in disaster. That stretch of highway? That's called the sequence of returns risk, and it's the single most dangerous threat to your retirement that almost nobody talks about. Let me put this on the map for you. What is sequence of returns risk? Here's the simple version. When you experience market downturns matters just as much as whether you experience them at all. Let me show you why with two investors. We'll call them Sarah and Tom. Sarah retires in 2025. Her first 3 years of retirement, the market is strong, up 8%, 10%, 7%. By year 3, she's withdrawn money for living expenses, but her portfolio has still grown because the gains outpace her withdrawals. Tom retires in 2026. His first 3 years, the market drops 15%, rebounds 5%, drops another 8%. He's withdrawing the exact same amount as Sarah for living expenses, but because he's selling stocks while they're down, he's locking in losses. By year 3, his portfolio has been devastated, not because he spent more, but because the order of returns destroyed his foundation. Sarah and Tom had the same average market return over 30 years, but because Tom hit the sinkhole early, his retirement outcome was completely different. This is the danger zone on your retirement map, years 1 through 3. Think of your retirement portfolio like a Jenga tower. Every year you pull out blocks to pay for living expenses. If you start pulling blocks when the tower is stable and tall, no problem. But if you start pulling blocks right after someone's already shaken the table, the whole thing can collapse. Why 2026 specifically? Now, I'm not a fortune teller. I can't predict exactly when the next market crash will happen, but here's what we do know heading into 2026. We've had an unprecedented bull run post-pandemic. Interest rate environments are shifting. Geopolitical tensions are elevated. Inflation pressures remain. We are statistically due for a correction based on historical cycles. I'm not saying crash, I'm saying uncertainty. And uncertainty is exactly why you need a map, a clear, systematic plan that protects you whether 2026 is boom or bust. The Atlas Principle. You can't control the weather, but you can control your route. You cannot control the stock market, but you can control when and how you withdraw from your portfolio. And that control, that's the difference between a retirement that lasts 30 years and one that runs out in 15. Our next destination on the Atlas? The solution that removes the guesswork entirely.
All right, let's bring this down to earth, because here's the beautiful part. You don't need to be a financial genius to protect yourself from sequence of returns risk. You just need to know a little. And the strategy we're about to cover, it's called the bucket strategy. It's been used by financial planners for decades, but it's so simple that you can set it up yourself this weekend. Here's the core idea in one sentence. You divide your money into two buckets, one for safety, one for growth, so you never have to sell stocks at a loss. Let's break it down. Bucket 1, the bridge, your safety net. Think of this as your do not panic fund. What it is, 1 to 3 years worth of living expenses kept in cash or high-yield savings accounts. Why it exists? So that if the market crashes the day after you retire, you don't care. You're not selling stocks. You're living off this safe, stable cash while the market does whatever the market does. Example. Let's say you need $60,000 a year to cover your bills, groceries, health insurance, and that annual trip to visit the grandkids. 1 year of expenses is $60,000. 2 years is $120,000. 3 years is $180,000. Most experts recommend keeping 2 to 3 years in bucket 1. That gives you a buffer to ride out even a severe downturn without touching your stocks. Where to keep it? High-yield savings accounts, currently earning 4 to 5% in 2026. Money market funds, short-term treasury bonds, certificates of deposit, CDs. These aren't going to make you rich, but they're not supposed to. They're your insurance policy against bad timing. Bucket 2, the growth engine, your long-term portfolio. This is where the wealth building happens. What it is? Your diversified stock portfolio. Index funds, ETFs, mutual funds, dividend stocks, the assets designed to grow over time. Why it exists? Because even in retirement, you need growth. If you're 60 and retire today, you might live another 30 years. That's 3 decades of inflation eating away at your purchasing power. Cash alone won't cut it. You need your money working for you. The magic of the 2-bucket system. When the market is up, you refill bucket 1 by selling some gains from bucket 2. When the market is down, you leave bucket 2 alone and live off bucket 1. You are never forced to sell stocks at a loss, ever. How it works in practice, a real-world scenario. Let's say you retire in January 2026 with $1 million portfolio. Bucket 1, $180,000, 3 years of $60,000 living expenses in high-yield savings. Bucket 2, $820,000 in diversified stock funds. Year 1, 2026, the market drops 12%. Your bucket 2 is now worth $722,000. Scary, right? But here's the key. You don't touch it. You live off the $60,000 from bucket 1. Your bucket 2 has time to recover. Year 2, 2027, the market recovers, up 9%. Your bucket 2 is now worth $787,000, still below where you started, but climbing. You continue living off bucket 1. You now have $60,000 left in cash. Year 3, 2028, the market is up another 11%. Your bucket 2 is now worth $874,000. The recovery is nearly complete. You refill bucket 1 by selling $120,000 from bucket 2, selling high this time, bringing your cash reserves back to 2 years. What just happened? You survived a market crash without locking in any losses. Your portfolio had time to heal, and because you weren't forced to sell low, your long-term retirement security is intact. Compare that to someone without a bucket strategy who was forced to sell $60,000 of stocks each year during the crash. They locked in losses. Their portfolio never fully recovered. By year 10, they're in trouble. The key know a little checklist. What you need to do. Calculate your annual expenses. Not what you think you'll spend, what you actually spend. Track it for 3 months if you need to. Multiply by 2 or 3. That's your bucket 1 target. Move that amount into safe, liquid accounts. Don't leave it in stocks. Don't chase high returns with it. Boring is beautiful here. Leave everything else in bucket 2, invested for growth. Rebalance annually. Once a year, pick a date, maybe your birthday, maybe January 1st. Review your buckets. Rebalance if needed. This isn't a set it and forget it forever strategy. It's a set it and check it once a year strategy. That's it. 5 steps. You don't need a PhD in finance. You just need to know a little and act on it. Now, let's talk about why this matters right now as we head into 2026. The economic reality check. We're living in unusual times. The post-pandemic recovery created market gains that many analysts consider overextended. The Federal Reserve's interest rate policies are still adjusting. Global supply chains are fragile. Election years historically bring market volatility. We haven't had a major correction in several years. Again, I'm not predicting doom, but I am saying if you're retiring in the next 12 to 24 months, you cannot afford to hope for the best. Hope is not a strategy. The bucket strategy is. What this strategy does for you in 2026. 1. Removes panic from the equation. When the market drops 10% in a week, and it will eventually, you won't lose sleep. You'll know your living expenses are covered for the next 2 to 3 years. 2. Gives you control. You're not at the mercy of market timing. You've systematically built a buffer. 3. Protects your legacy. If you want to leave something for your kids, your grandkids, or your favorite charity, running out of money isn't an option. This strategy keeps that possibility alive. The adjustment for today's rates. One bonus of the 2026 environment. Cash actually pays again. High-yield savings accounts are offering 4 to 5% right now. That's not spectacular, but it's leagues better than the 0.01% we saw a few years ago. Your bucket 1 isn't just sitting idle, it's earning a modest, safe return. Take advantage of that while it lasts. So here's what I want you to do after you finish watching this video. Step 1. Grab a piece of paper or open a spreadsheet. Write down these numbers. What do you spend per month right now? Multiply by 12, that's your annual need. Multiply by 2 or 3, that's your bucket 1 target. Step 2. Look at your current portfolio. How much do you have in cash or cash equivalents right now? Is it enough to cover 2 to 3 years? If not, it's time to make a move. Step 3. Don't wait for the perfect time. The perfect time to build bucket 1 was 5 years ago. The second best time is today. If the market is high right now, great, sell some gains and move them to safety. If the market is down, prioritize adding new cash to bucket 1 before investing more in stocks. Step 4. Automate the process. Once a year, pick a date, maybe your birthday, maybe January 1st, review your buckets, rebalance if needed. This isn't a set it and forget it forever strategy. It's a set it and check it once a year strategy. Step 5. Share this video. If you found this valuable, I guarantee you know someone else over 50 who needs to hear it. Your brother-in-law, your college roommate, your neighbor who's always talking about retirement. Send them this link. You might just save their financial future. Final thought. The map is drawn. Now you have to follow it. The Investor Decision Atlas has given you the map. Mr. Know a Little has made it simple. Nick Invests has shown you it's relatable and achievable. But here's the reality. Knowing the strategy isn't the same as implementing it. You can have the best map in the world, but if you never take the first step, you're still lost. So I'm asking you, what's stopping you? Is it fear? Is it procrastination? Is it the belief that someone else will figure it out for you? No one cares about your retirement more than you do. Not your employer, not the government, not even your financial advisor, unless you pay them to care. Take control, build your buckets, sleep better at night. Because the market will crash again. We just don't know when.
And when it does, you'll either be protected or you'll be one of the people wishing they'd watched this video and actually done something about it. Don't let that be you. If you want more strategies like this, real, actionable financial planning that doesn't require a finance degree, hit that subscribe button and turn on notifications. We're here to help you navigate